All right, let's get right to it. S&P 500 futures are locked in a holding pattern, just dead flat, sitting right at 6,945 in the overnight session.
Dead flat. And if you're looking for any kind of directional conviction this morning, well, you're not going to find it.
No, there is zero consensus, and that's coming right off the back of some really conflicting signals yesterday.
And that flat line, it tells you everything you need to know, especially after the Dow just blew past 49,000. I mean, another historic high.
So we're at this extreme high altitude, but the market's just hit the pause button.
It has. And even though we're at all-time highs, you have to look at the VIX. The Institutional Volatility Index, it's ticking up. It's at 15.1 right now.
And that's a clear signal.
It's an explicit signal that institutional desks are actively hedging. After that relentless 3-day post-holiday rally, the smart money is putting on protection. They are not adding new risk.
So you've got euphoria in the Dow, but you have this institutional fear creeping in through the VIX. What's the immediate catalyst that's got the tape paralyzed this morning?
It's the labor market. We've got a double header scheduled for the early session, and this is what the entire macro narrative is waiting on.
Okay, what are the prints?
First up is ADP private payrolls at 8:15 a.m. Eastern. That's a huge leading indicator. And then you get the official JOLTS job openings report at 10:30 a.m. These two releases will completely dictate the outlook for the Fed's 2026 rate path.
Right. And we know the game here. It's the 2026 Goldilocks hunt. We're all looking for that perfect, almost paradoxical outcome from the labor data, aren't we?
Absolutely. The market's objective is singular. We need the data to be soft enough to validate that dovish Fed pivot everyone is priced in for later this year.
Yeah.
But, and this is the critical part, it also has to be strong enough to prevent a panic that the consumer, the bedrock of this economy, is completely cratering.
Too hot, the Fed stays tight. Too cold, we start pricing in a recession.
Exactly. We're hunting for that perfect middle ground, and today's data points, they're the primary compass.
And just quickly before we jump into the movers, that secondary context from last week, the geopolitical risk from the Venezuela shock, are we confident that's unwound?
Oh, I think it's done. That initial energy risk premium is already being harvested by traders. The narrative just aged out really fast once the complexity set in.
So it's not a quick fix.
No. Traders realize stabilizing Venezuelan production is a multi-year political and logistical effort. It's not a short-term supply solution. We're seeing that in the flows this morning.
Okay, which brings us to the tape itself. The Dow is sniffing 50,000. That sounds euphoric. But if you look under the hood at the pre-market flows, you see storage stocks surging, while energy names are fading.
It's a violent rotation.
So is this a healthy broadening of the bull market, or is this the final distribution before, say, a sharp 10% January correction?
I'm leaning toward technical exhaustion driving this, not a healthy expansion. What we're seeing is a pivot in capital flows. Money is aggressively leaving high multiple, expensive compute, think NVIDIA, the training phase leaders, and it's flowing into bottleneck infrastructure assets.
A structural maturity sigma.
That's a perfect way to put it.
And the poster child for that shift this morning has to be SanDisk SNDK. It's riding a massive 28% momentum wave pre-market. Why flash storage? Why now?
Well, the insight here is fundamental. The AI cycle is maturing. For the last 2 years, it was all about the training phase, right?
Yeah.
Building massive chips, training these huge models.
Right.
We're now moving aggressively into the global inference phase. That means deployment, real-time use across hundreds of thousands of data centers.
And that requires a different kind of infrastructure.
Immense, fast, scalable flash storage capacity, not just compute power. And SNDK is a direct, pure-play beneficiary of that rotation.
That training versus inference phase distinction is so key to understanding where the capital is going. Okay, let's pivot to a totally different sector. Wolfspeed, WolLF, surging 9.6% pre-market.
This is a great story. It's a story that merges strategic industrial policy with just massive financial de-risking.
A double catalyst.
A perfect double catalyst. First, the liquidity.
Yeah.
They got a $698.6 million tax refund from the CHIPS Act. That's a game changer. It instantly de-risks their balance sheet.
And the second part?
The second part is long-term demand certainty. They locked in a major silicon carbide or supply deal with Toyota, and SIPCase is absolutely essential for the next generation of high-efficiency EVs.
So short-term cash, long-term demand.
Exactly. It's a fantastic setup.
All right, so for our traders watching the implied open on Wolty, it's gapping up huge. We need surgical levels. What's the line in the sand?
You have to watch the psychological $20 handle. If the stock can hold this pre-market gap and clear 20 bucks with a clean 15-minute close, then the bull target is $21.50. That's the next key institutional resistance.
And if it fails?
If it fails to sustain the move, that suggests a sell the news reaction. That opens up the bear target for a quick gap fill right back down to the 50-day moving average, which is sitting at $18.20. That is the critical support level.
Okay, now for the unwind. Chevron, CVX, down 1.8% pre-market, just extending yesterday's slide. This seems to confirm that Venezuelan narrative shift you mentioned.
It does. The market seems to have front-run the realization that the Maduro capture rally has peaked. Traders bid up oil on the initial shock, but now they've absorbed the fact that getting Venezuelan production stable is a multi-year project.
The premium is just being harvested.
It's being harvested. Unless we get a fresh, dramatic escalation, money is rotating out of those energy names.
Let's talk Flow Watch. This tells us where the real institutional conviction is. Novo, Nordisk, NVO. We're seeing some unusual options activity there, even with a slight revenue miss.
The flow is exceptional. I mean, call volume is tracking 37% above its 30-day average. This is significant smart money positioning. It suggests they're setting up for a major Q1 breakout.
And they're just ignoring the revenue miss.
They're looking right past it. Yes, they missed slightly, $11.79 billion versus $11.98 billion expected. But the options desk is signaling they're playing the long-term GLP-1 expansion story.
So institutionally, they're buying the small dip as an opportunity to load up. What are the actionable levels for NVO?
The bull target is $148. That's a reclaim of the 52-week highs. A break there will trigger the technical breakout those options traders are positioned for.
And the downside.
The primary support, the indicator of institutional distribution, is $139.50. A breach there means that revenue miss is starting to matter more than the long-term story.
We have to shift to Apple AAPL. I mean, it's a key anchor of the Magnificent Seven, and it is showing clear textbook technical weakness right now.
That's right. The daily chart for Apple has now confirmed a major head and shoulders reversal pattern. It moved decisively below key support at $266.95 and $265.32.
And when a stock with the weight of Apple shows that kind of breakdown, it sends a ripple across the entire market.
A huge negative signal across the entire high-beta tech sector. You can't overstate the psychological impact of seeing a market leader show such textbook weakness.
So for those who aren't chartists, what does that pattern functionally signal?
It's a classic bearish reversal pattern. It signals the end of an uptrend. You get three peaks, with the middle one being the highest, the head, and then a decisive break below the neckline support.
And that break below $265.32 is confirmation?
That's the confirmation. The downside measured move is now officially in effect.
So for anyone long Apple right now, what's the play? What do they need to see?
The bulls need an immediate, fast, and aggressive stop hunt recovery. They have to reclaim $268 today. If they do that, it would invalidate the pattern and could trap some shorts.
And if they fail to reclaim it?
If they fail, the measured move for the bears points sharply lower down to a target of $252. And you need to watch the relative volume. If downside volume is heavy today, it confirms that institutional distribution is accelerating.
Okay, shifting to the overall market structure. Yesterday's S&P closed at 6,858, puts us at historical valuation extremes. We're talking 22 times forward earnings. You mentioned technical exhaustion earlier.
We are seeing extreme technical exhaustion. The current January bar is registering as a number 8 on the exhaustion count.
And historically, what does that mean?
Historically, that kind of signal, especially when you combine it with these valuation levels, it often precedes a 5 to 10% mean reversion move. The market is just too stretched. It needs to breathe.
Okay, let's drill down. S&P 500 futures, the ES. Given that exhaustion and the data, wait, what's the tactical line in the sand today?
The S&P is pinned. It's in a multi-day range. Resistance is right there at 6,895. That's the psychological level. You need a clean 15-minute close above 6,900 to invalidate this whole exhaustion narrative.
And on the support side?
Critical support is 6,825. That's the high volume node from back in December. If that fails, it opens the trapdoor immediately down to 6,780.
So the strategy is just purely neutral heading into the data prints?
Exactly. Strategy is neutral until we get confirmation. I'd expect a fake-out move around the data, designed to liquidate weak hands before the market returns to that 6,860 median pivot. Bulls are targeting 6,920. Bears are targeting 6,780.
And for the Nasdaq 100, the NQ, it's struggling with concentration risk, leadership is patchy, and now Apple is wobbling.
It's a tough spot. Major supply sits at 24,850. You should expect sellers to defend that zone aggressively unless you see fresh, coordinated institutional inflows into the heavyweights, like NVIDIA and Microsoft.
So sell the rips toward 24,800.
Fundamentally, yes, that is a sell zone until the technicals clean up. Technology is no longer the safe haven it was in 2025.
And what's the key support level to maintain the trend?
24,420. That is the critical trend line support from the entire Q4 rally. A decisive break there signals that capital rotation into old economy value is accelerating. If 24,420 fails, the immediate bear target is 24,200.
So let's add this all up. Record highs, VIX is up, tape is flat, technicals are exhausted. Is today a breakout opportunity or is this a systemic trap?
It is unequivocally a liquidity trap. Sentiment is neutral, and positioning is what we call maximum stretched. This is a classic risk setup for active traders.
Explain the mechanic of that trap. How does that stretched positioning create a trap around a data release?
Well, institutions are basically hiding in index futures, just holding tight while they wait for JOLTS to confirm the rate cut path. But because positioning is so stretched to the long side, you have to anticipate that any initial spike on soft data will be met with immediate aggressive selling.
So the spike is just an opportunity for longs to get out.
It's an exit ramp. It provides liquidity for them to de-risk their positions. Do not confuse that initial jump with a genuine breakout.
Okay, let's talk about the big anchor holding everything down, the bond market. The 10-year Treasury yield is hovering at 4.17%, near 4-month highs. How much of a headwind is this?
It's a subtle but profoundly powerful headwind. That 4.17% yield acts as a gravity check for all high multiple growth stocks. Yes, AI momentum is the fuel, but the higher that 10-year gets, the heavier that gravity becomes. It fundamentally compresses the present value of future cash flows.
So there's a critical threshold, a number we need to watch where the math really starts to break down for these valuations.
Absolutely. The threshold is 4.20%. If the 10-year yield breaks 4.20% and sustains it, you must expect the valuation police to start aggressive, non-discretionary profit-taking.
And that would be across the whole tech complex.
The entire extended tech complex, that's the level that changes the mathematical calculus, and it makes those 50 times PE stocks look fundamentally questionable.
This leads right to the biggest vulnerability for many listeners. Let's call it the retail pain trade. What is the duration trap that smaller investors are missing while they're chasing these parabolic AI names?
The duration trap is simple. They're treating these long-duration growth assets, your Microns, your Western Digitals, as if they're bulletproof momentum plays. They're forgetting how extremely sensitive they are to bond yields.
And they're ignoring the risk of a bear steepener.
Exactly. And for clarity, a bear steepener is where the long-end yields surge while the Fed stays patient on the short end.
What happens then?
If the 10-year spikes rapidly towards, say, 4.35% or even 4.50%, the result is a violent and shocking rotation. Capital gets yanked out of those AI forever stocks and forced into real asset defensives and value plays.
And what's the actual quantitative hit on those growth valuations if we get to 4.50%?
Well, the trap is assuming that the dip will be temporary. But at 4.50% yields, the mathematical fair value of a stock that's trading at 50 times forward earnings drops by 15 to 20% instantly.
This isn't just a fluctuation.
No, it's a permanent repricing event driven by macro reality. So the bottom line is, do not confuse high momentum with fundamental safety, especially when the bond market is pressing like this.
A stark warning for a morning where we are seeing so much exhaustion. Let's wrap up our tactical brief.
Keep your position sizes extremely small today. This morning is about capital preservation and managing your levels, not hitting home runs. Avoid chasing the initial data spikes, and definitely avoid the extreme volatility we expect around that 10.0 a.m. JOLTS print.
So with the S&T's exhaustion count at a number 8 and that 4.20% 10-year yield threatening to break out, you have to ask yourself one final provocative question as you set your playbook today.
Are your current long positions truly prepared for the high beta tech crash that the bond market is quietly signaling? Is your long exposure truly bulletproof against a sustained 4.50% yield environment?
The answer to that question really dictates your risk posture for the entire quarter.
It does. Stay nimble, manage your levels, and we'll be tracking these flows all day.